the program over the next 2 days. Hamilton Lane is our private markets partner, and we're happy to welcome Jackie Rantanen, who I think is in the back. Jackie, stand up, please. Her colleague Dave Helgerson. They co-head the impact investing at Hamilton Lane. Tim Darcy, who's a great friend of CIS from Hamilton Lane, and of course our keynote speaker, Drew Schardt. You're going to see him in a minute. But I was lucky enough last week, thank you very much. I was lucky enough last week to be at the Hamilton Lane annual meeting in Philadelphia. When are you guys going to go to Palm Beach or? Anyway, so it was a great action-packed program. But they've been so I've got a little bit of a preview. I had a little bit of a preview of Drew's presentation, but I think you're really going to find it thought-provoking and educational. But as Jack Brennan likes to say, Hamilton Lane treats us way better than we deserve to be treated, and I think that reflects the culture and values and quality of that firm. So please join me in welcoming Drew Schardt, Head of Global Investment Strategy at Hamilton Lane, who will be our keynote speaker. And Drew is, depending on timing, Drew said he's more than happy to take questions after his presentation. So, Drew, thanks again. Yep. Great being with you.
Yep. Appreciate it. All right. Thank you all for having us, and what a fantastic room and event. I'm glad to hear this is sort of now an annual tradition, although I will say Tom didn't say that I'd be following the Monsignor, so if we are, fortunate enough to be invited back, that's a tough act to follow for sure. And I also wanted to start by saying thank you. You can tell how much has gone into this fantastic setup, and I can speak firsthand. The team at CIS, Tom, Jack, Scott, and others have been first class and fantastic partners in all respects. So thank you for those pieces. Today, I was going to sort of kick off a little bit of navigating the private markets. And so a little bit of this presentation is demystifying the asset class because, my parents are public school teachers and were retired, but really the problem or the challenge with our asset class is it's just that. It's private. It hasn't been transparent. It's sort of a black box. And so if anything, I hope what I leave you with today is a better understanding of the asset class, a bit more of how does it work, and ultimately how we as a firm do what we do. And I'll start there. And again, this will be a very brief sort of overview of who we are, because you'll see when we go into the materials, it helps explain the footprint we've built over 30 plus years. And the Monsignor used the term reach. I'll use the term access, and it's a different sense than what the Monsignor was saying, but our entire mission over 30 plus years has been to bring greater access to investors, to new groups of individuals, to endowments, institutions, foundations, to find investments and access investments in this area that is lesser known, lesser understood. And ultimately, our mission statement is to enrich lives and safeguard futures so people can retire better, so people can live better, so they can do all the good things that things like CIS and we are hopefully partnering to bring to the world at large. We've been doing this for a long time. We like to say we're the biggest company you've never heard of. We manage just under $1 trillion of assets in this private market space. That is all that we do. We don't do anything on the public market side, so no public equity or public fixed income. It is just investing and finding these private businesses and investing in them in different shapes and forms. Last year, just to give you a sense, we deployed about $40 billion into this asset class. So it gives us a massive footprint. It gives us massive access. And it gives us, as you'll see in a minute, a lot of information and data that we think is critical to helping, again, demystify the asset class, helping people understand, get comfortable with it, because we are believers in the value that it does have long-term in terms of some of the goals and mandates that many of our clients and organizations put forth. You can also see we always list our sort of mission statement and values down the side of the page. We're a publicly listed company, ironically, even though all we invest in is the public market or private market. So you can read more about that. But this is, I think, the footprint that I was just speaking through. It's something that is hard to replicate. It's something that we've built, and every time we take on a new client or form a new partnership or work with different groups of investors, it all sort of gets funneled into this massive database that we have. We have big teams around, a lot of technology around, because it makes it easier to use, it makes it easier to disseminate. But importantly for this presentation, you'll see what it fuels in terms of the data, the comparisons, the sort of understanding that we're able to put forth because of that footprint of data and information in an asset class that, as you'll see, has grown quite significantly over the past 20 years. So enough of the Hamilton Lane commercial, and as I said, I'm happy to take questions at the end, so there'll be plenty of time to follow up or ask questions on any of the materials. But again, let's start at a very, very high level. So what are the private markets? Think of the private markets are, listen, we could all pull out our phones and you can buy any public stock you want. Everybody has the same access, everyone has the same information. There is a realm of companies that is literally 10 times the size in terms of numbers of companies that are in the public space. And I get questions, well, what does that mean? We're talking about companies that have at least $100 million of revenue. So we're not talking about, you know, small or mom and pop. We're talking about real sizable businesses that if they're public, you can access and invest in them. But if they're a private company, you cannot. And so our industry, our asset class, goes out and finds and accesses and helps build those businesses that are private. And you can see from the bar charts here, and I know it's hard to read maybe, but the light blue bars are the percentages of companies that are private, and the dark blue bars are the percentages of public. And again, if you think about that, if I told you I can offer you 100 things to invest in, the private markets, or I can offer you 10 things to invest in, that's part of the reason, as you'll see, that when you can access that landscape of companies, not only does it diversify your universe, there's the ability to create performance, returns, and results that is harder to do in an efficient public market context. And as I said, this is a space that isn't new for many, even though there are newer groups of investors accessing it. What we're showing you on the left-hand side of this page is where we were in the year 2000 with the asset class, about $600 billion. And now comparing to where it is today, about 20 years later, it's nearly 20 times the size of what it was. It's just under $10 trillion of assets. Most of the investment historically has come from bigger institutions, pensions, endowments, corporate foundations, and things of that nature that are used to this asset class and have known about it and continue, frankly, to lean in and do more in the space. But I think where the asset class continues to go is to that newer group of investors that may have limited or no exposure. It can benefit their portfolios. But even at the individual level, and like I think about my parents, if they had access or better access to private market returns when they were teachers, when they were 401k, retirement plans, et cetera, they would have benefited from what you're going to see in terms of some of the performance. Here what we're showing you is just a bit of how value is created in companies, and it's very different, and this is, I think, why the private markets continue to expand. So if you look all the way to the left, there's Amazon. It went public in 1997. The bar on the left side, I think that's the dark blue bar, shows you the value that was created for investors while that company, Amazon, was private. And then when it went public in 1997, you can see the numbers of what the value was created as a public company. And for Amazon in the late 90s, that was great to be in the IPO or invest in it as a public company. That's where the lion's share of the value creation or the value build happened. But as you can see, as we move to Google, Facebook, so over the last 20 plus years, the ecosystem of private companies and the financing available to those companies when they are private has expanded. What does that capital do? It helps them grow, it helps them invest, it helps them build their employee base, it helps them acquire other companies. And what has happened, as you can see, is now the bars on the right-hand side, when the company was sort of public, is much smaller and dramatically, smaller than the bars on the left for those three on the right. That's confusing, left on three on the right. Essentially what it's saying is more value has been created with those companies while they were private. So if you could find ways or partners to access those companies while they were private, you did much better than when you can access it when those were public companies. And not surprisingly, the number of public companies in the United States has essentially been cut in half over the last 25 years. And so, again, investable universe that is shrinking. The private company landscape is going the opposite direction. And you can see that the diamonds disappeared. But essentially, what it shows you is not only when companies go private are those IPOs bigger because they've been built as a private company for longer periods of time, but the length of time they stay as private companies before they went public is actually increased by 50%. So in 2000, it was generally any IPO in that year, the company had been around for about 8 years. Today, that statistic is close to 13 years. So again, because this ecosystem continues to evolve, because companies may in some cases prefer to be privately owned, they don't have to report to shareholders, they don't have to sort of have the pains and arrows of being a publicly listed company, they're staying private for longer. Before we get into, okay, what does all that mean? What about the performance? I think it's relevant, and obviously it's some interesting times on the macro, and I won't spend a ton of time on this, and I'm happy to talk through any of it as we move forward. But I think we're particularly relevant now in this past 12 months or past year. In the investment world, you don't have to know a lot about it to know that over the last 15 years, but for this last one, things have been pretty much up and to the right. Lots of liquidity, low interest rates, lots of growth, valuations, and prices of things sort of have continued to increase. That's all pivoted pretty dramatically over the last 12 months. And so now, not only do you have changes with interest rates and the level of liquidity and Silicon Valley Bank and banking system concerns that are sort of dampening what has been happening, you have all sorts of other issues that make investing a little bit nerve-wracking, a little bit choppy. It's up and down more so than it's been in the last 15 years. And so what are the central banks trying to do about it? And I'm sorry, we won't get too nerdy here. We tend to be nerds as well. But I think this is what they're wrestling with. The economy was bound to slow down at some point. Everyone sort of appreciated or accepted that. It's funny because now when things do start to slow down, everyone starts to panic a bit, even though everyone sort of said they knew this was coming. And so now you're left in a spot where what the central banks, the Fed, the European Central Bank, Bank of England, Bank of Japan, they're trying to use interest rates and that sort of monetary policy to make sure we have maybe a softer landing. They know they have to slow and cool the economy so inflation, the prices we all pay, stop just going up at 10% a year. They've started to do that, but it's a balance because they also don't want to slow things down too much where you have that second scenario, harder landing, much more severe, has more severe consequences for portfolios and value destruction and demand destruction. And so that is a very unique time because we're frankly in a period of inflation that we haven't seen in a generation. And the interest rate and monetary policy has also been pretty unique and synchronized in terms of the banks moving interest rates upward. And so they are threading this needle of trying to generate the top sort of delicate, milder recessionary scenario. It's our house view, by the way, that we think that will occur. You're going to start to see, and you already have, interest rate increases will slow and probably stop over the next 3 to 6 months. But it doesn't mean that there's not risks. And so just a few here. I think this is sort of the geopolitical context. And again, not going to talk politics here or anything else. But this, just as it relates to investing, this is also what makes it hard. Because the nerds can talk about interest rate policy or this investment or this company, but at the end of the day, the world continues to be choppy, to be uncertain, and that also creates risks for how you think about investing and deploying capital. And so the question is, what should you expect from this private market asset class over the next 1, 3, 5, 10 years? And I think the punchline, just so not to bury the lead a little bit, is the private markets tend to do some of their best work when times are volatile, when times are choppy. There's a different ownership structure in private companies than there is in the public world, and that makes for different outcomes and different results. And so looking back over the last 5 years, this is the value of $1 if you invested it in public equities, S&P 500. I think we're showing the MSCI World here. But essentially, your option to invest in public markets, public equity markets. Here's what's happened, and I'd point you to the top line. This is from our database, and again, there's 100,000 companies, 50,000 funds. So it's about, we think, 60 to 70% of the total private market landscape. This is the average performance, average net performance of the private markets. And you see, it is correlated to what's happened in terms of the shape and directions of the lines. But you've gotten a meaningful outperformance by investing that same dollar 5 years ago into the private landscape relative to the public side. There's also different ways, just like in the public world, you don't just have to invest in equity. You can invest in credit. You can invest in real estate. Back to all those bubbles that you saw earlier, that's part of why all those bubbles continue to grow. It's not just one flavor of ice cream in the private markets like it kind of was in 1999 and the early 2000s. Today, there's a lot of different choices, and you see we show the same thing. The purplish thing is private real estate, and then the orange bar is private credit. Very different risk and downside characteristics for those strategies, but the returns look pretty good. But that's just one period of time over 5 years, and directionally over the last year, we'll talk about it in a minute, it's kind of slowed down a bit. But what about longer periods of times? Because one of the drawbacks of the private markets, unlike the public world is great because you can buy and sell at any time, right? You have the ability to control that. It is a liquid market. It's not the case on the private side in most structures. So you basically are investing $1, but you know that that dollar largely won't be returned to you, all those returns, for 7, 8, 9, 10 years. You're going to get better performance, but it is relatively illiquid. You can't get your money out when you choose, but for that, you're able to sort of benefit in terms of performance. What we're showing you here is S&P 500, MSCI World, and small cap MSCI World. So public equity benchmarks, and we're showing you at any point in time over the last 20 years, when you look backwards over the 10-year return, so rolling 10-year time-weighted returns, this is where the performance of the public markets have been. If I overlay the average net performance of the buyout, the private equity performance, you're hard-pressed to find many places on that top line when looking backwards at any point, the trailing long-term 10-year performance is eclipsed by any of those public market indices. This is the key part of why investors continue to lean in, why institutions can continue to lean in. It's not just outperformance, it is how consistent that outperformance has been relative to other places to put your capital. And my compliance department's not in the room, but I don't know if the next 20 years will be the same, but this is a tough trend to bet against, in our opinion. It shows you the value of the private market landscape. But as investors, we all like to look what is right in front of us, what has happened, back to the headlines you saw, doom and gloom, all sorts of negative pieces. And yes, public indices have corrected meaningfully over the past 12 months, very different than the last 15 years when they were all sort of up and to the right. What have the private markets done in the same context? They've also gone down, but again, the outperformance isn't just upside capture, it's also how the asset class protects on the downside. And so while you see, again, returns are sort of moving in the same direction or correlated, the impact to the private markets on average in equity, in credit, in infrastructure, and real assets, this is sort of better than your experience over the last 12 months by investing in the public realm. We're going to talk through in the next section, I'm going to do some myth busting and things we hear and skeptics. I know we all tend to be skeptics, I do. So we're going to talk through some of, well, why is this? And if you remember no other chart from this deck, remember this one. This is probably the most important chart in the deck, because what it is showing you across this horizontal x-axis is different S&P 500 returns over sort of a trailing 3-year basis. On the far right, the S&P is roaring. It's doing really well. It's greater than 15% returns, and this looks back over 25 years. And then in the sort of far left, it's when the public markets have a negative return, sort of like what we saw last year. The blue bar compares the average net performance of the private market versus investing in the public space. And essentially what it is telling you is that actually the private markets, again, do their best work when there's more pedestrian public market returns, when there is negative returns. It doesn't mean that the return performance just goes up. It also comes down on an absolute basis, but on a relative basis, back to if you had $1 to invest in the public side or the private side, this is telling you even if returns come down across all areas, public or private, which I think they will a little bit, you're still better off leaning into the private market strategies. And then this is just breaking it down by vintage year. Again, average net performance, equity on the left, credit on the right. The dots are the public market equivalent, PME. That means, again, the opportunity cost or investing that same dollar into the public realm. The dark blue bars are the average net of the buyout and the origination direct lending side of the thing on the credit piece of it. And again, in buyout, it's 20 for 20. Your average returns have been better in 20 of the last 20 vintage years. In credit, I think it's 19 of the last 20 years. And so that, again, to us is a pretty consistent and hard message to bet against, and partially why we think not only does the amount of investment in this area continue to increase, but it's just taking advantage of a bigger opportunity set when it comes to private companies relative to the public side. And this is a little bit of just how capital goes in and out of our asset class. And you can see it's been on a pretty steady rise. On the left is the contributions, the amount of capital going in. And everyone likes to say, oh, things have stopped, deals have stopped happening because everyone's worried and there's volatility in the markets. That's true, things have slowed down. But if you look at the most recent bar, yes, it's down year over year in the private side, but it's still at the second highest all time in terms of groups investing capital into this space. This is because, again, when you purchase an asset in our world, you know you're going to have to live with it for 4, 5, 6, 7 years. We're not buying these things to flip or turn over in a month, a year, 2 or 3 years. We're holding, we're building, we're making the companies better, and at some point that we control, we sell the asset. It's very different than a public market investment where you don't really control the ability to build value, to control the company, to align incentives. That's part of the reason why capital continues to go in. And same on the distribution side. So that's the capital coming back to you as the investor. And while they're down year over year, you see how consistent the asset class, those different colors are each of the last 4 quarters. They've been returning capital back at a strong rate to investors. And that's partially due to the evolution of the space and having more ways in different, credit or real estate or infrastructure, different ways outside of just equity to invest. All right, so this is, again, I don't know if I need to apologize for it. We are nerds, and so we have a nerdier sense of humor. And so this is our segment called sort of Mythbusters. And so these are some of the questions or pushbacks or the skeptic's view on some of, what I just talked through. And the first is, well, your asset class is really risky. I hear they use a lot of leverage. I hear things, can be very bad in certain companies or investment opportunities because they're private. It's less sort of rigorous in terms of the investment, regulation than the public side. First of all, we are a regulated industry. And I'd start with this. So the data tells the story better than I can. If you look at the blue bars, those are the average private market returns. The light blue bars are the average public market equivalent returns. And what we're looking at here is the lowest point. So you're looking at what is the worst 5 years over the last 25 years for public and private market returns by strategy. And it would tell you that even at its lowest point, for example, private equity, or the equivalent of like the S&P 500 in the private landscape, you still, at its lowest, worst trailing 5-year performance, got a 2.5% net level of return, which was better than the negative 5.5 or 6% you got in the public realm. Similar story on the credit side. The light blue bars are a bit higher. I think some of the colors got changed there. But the venture piece of it is also one that a bit more risky, but it also has more of the upside when things do recover. So it is a mix. There's not a one-size-fits-all approach, but this would tell you the downside isn't terrible. Another way to look at it is if you compare catastrophic risk, and what we're defining there is at its peak, companies that have lost at least 70% of value from their peak. In the public markets, the far bar on the right, you lose that value about 40% of the time in any given name that you choose. The private markets, it's just under 20%, so still 1 in 5 seems like a risky proposition. But when we build these funds, they have 40 and 50 and 60 or 100 companies within one single fund structure. So while your risk of loss is higher, for a specific deal, 18%, at the fund level, when you have these structures or these funds, it's only about 2.8% where you have one of these catastrophic risks. This chart got moved around a little bit, but I think this is one where this is just showing you it's not just private equity. There's private credit, there's private infrastructure, there's private real assets. They all have different characteristics that aren't just about the return. They're about risk and another downside, what happens in a negative environment. They're about liquidity. So equity, again, that's the 5, 6, 7-year hold. The average hold in private credit, 2, 3 years, a little bit shorter duration. And credit has different liquidity. So when you buy something on the equity side, you buy it, and then you don't get any money back, usually, unless you sell it 4 or 5 years later. Credit has interest and yield that comes off of it. So a long way of saying not only different risk and return pieces, but these different strategies also have different liquidity and duration characteristics. And as we think about navigating choppier times, the duration and liquidity pieces are really important to sort of insulate your investments from some of those risks. And then finally, on the it's too risky point, what we're showing you here is of all that 50,000 funds in our database, how many of them outperform as a percentage the same strategy with the same cash flows and timing in the public side. And if the sort of dark blue bar is bigger than the light blue bar, it means that most of the time, the average private equity fund is outperforming the public market equivalent. You see how that's sort of evolved over time, and even recently, it's pretty meaningful, consistent outperformance than your opportunity cost on the public side. All right, the other thing I get is, well, of course the performance is better because you private equity folks, you mark the investments only once a quarter, so you're only touching it 4 times a year. The public realm has daily pricing, minute-to-minute pricing. It's bought and sold constantly. And so that's why the returns have looked so good, because you're just picking a value that isn't true. Not the case. And so if you look at the chart on the left, this is comparing the purchase price multiple on average in the private equity world versus the same type industry company, GICS code, which is the industry classification code of a public company. So the same company in the public realm versus the private realm. If the bar is green, it means on average in that year, the private company was purchased at a discount to where the same company was being held at a multiple in the public realm. In 14 of the last 17 years, just before the GFC, you can see on average, investors in this space that can find those companies, that can access those companies, on average are buying them at a discount to where the same company they could buy in the same public sector, the same size, et cetera. Again, the arrow's got a little bit tweaked here on the chart on the right, but this is showing you where the investments were held just before the current downturn. Those are the light blue dots, and then where they were or are as of the last marking date. And what it's telling you is, again, where they start, most of those blue dots by industry class were at a discount. If it's at above that line, it means the private investments on average are at a discounted multiple to where the public markets were. You can see, as the markets have gone down on the public side, so too have most of the private market investments, as you saw earlier, and also so have the valuation multiples. They've also come back more in line, but again, we had more cushion because we're starting out at a lower purchase price multiple than the public markets. So if the public markets go down 20, we have less to fall or less to go given where we bought in those companies, and the same holds true from where they're holding the value of the assets. The other thing that sort of factors in on the private side is, again, it's a different governance model. When we buy one of these companies, we control the asset, we control the board of directors, we can align incentives with equity and other things with the employee base. We can make decisions that we know, back to we have to live with the asset for 5 years. We know there's going to be choppiness. We know there's going to be volatility. 5 years is a long time. We can't predict everything. We need to structure and build the company in a way it's going to be resilient. What we're showing you in those dark blue bars are the sales and earnings growth levels over the last 12 months. And so even though valuation multiples have come down, most private companies are still generating double-digit top-line growth and similar on the earnings level, or EBITDA, the nerdy acronym for that. The light blue dots there are the S&P 500. Again, still very healthy levels of growth in the public markets, but it's outstripped by the growth that has been generated through that governance model on the private side. And then combining that with another factor, and this plays more into what lay ahead, riskier times, a lot more volatility, you're also in a spot, if you look at the chart on the right-hand side, whether you're talking, and this is true for both public and private asset classes, the margins or the profitability of these businesses is at all-time high levels. So as you're preparing your portfolios, or these companies are preparing to weather a bit more of uncertain times, volatile climates, an economic storm, over the next 12 to 24 months, they're starting at a spot not only from the earnings fundamentals, but from the margin and profitability where they have more cushion because of the performance that they've been generating. Excuse me. And then finally here, we're showing you the movement in the light blue lines of the public markets over the last 4 or 5 quarters and the movement of the average net IRR of the private markets. And again, you can see the asset classes are correlated. They generally move in the same direction. We compare it to the GFC, we compare it to the dot-com downturn, and you can see it's very directionally similar. And at the same time, you can also see it's generally been, historically speaking, 3 to 5 quarters before the sort of trend changes, where the capitulation in values and pricing and returns starts to pivot and go back upwards. And in the current context, you can see it's very similar. It's been correlated. It's followed the public market levels of returns and performance. And we're about 3 quarters in, so if the 3 to 5 is sort of an indicator, it says you're closer towards potentially turning upwards, assuming there's a lot of assumptions, but assuming things stabilize a bit at the macroeconomic level. And it also doesn't mean that private markets won't drop a quarter or continue to go down. But if they do, it won't be because the valuations are fictitious or they're made up. It is because the public markets have continued to go down, if that indeed continues to be the case. The other piece we get is, well, it's been great historically, 20 years, but you said it was a very small asset class that's grown pretty quickly, and it has, and again, $10 trillion of asset class size isn't anything to sneeze at, but if you compare that to the public equity world, that's $50+ trillion of size. So it's still, 20% of the size, depending on what index you use. And our world includes credit. If you add credit to the public sphere, you're talking about another $200 trillion of size in the public realm. So it has grown a lot, but it is still on a relative basis small. But the question becomes, well, as it grows, can you continue to generate that same level of performance or outperformance that you had historically? And so here's just showing you the fundraising. It continues to be strong. I think showing you investors continue to, like and put capital into this asset class. You can see here, though, part of that is a proliferation of strategies. So it's not just equity, it's not just venture and buyout like it was in the 1990s and early 2000s. In our world today, there's different sub-strategies in equity. There's venture, there's different sub-strategies within venture. There's credit, there's different sub-strategies within credit. And so, long way of saying there's more choice for investors. So that is a big part of any nascent, evolving asset class: more choice, more strategies, more ways to manage and tailor your exposures, your returns, your duration, your liquidity, et cetera. That's true of our asset class. And then if we look at the dispersion of returns, it's actually continued to get wider. So this is showing you bottom to top quartile in the private landscape. And again, I think partially because of all those different strategies and sub-strategies, there's a widening of returns. This isn't an efficient market. Access isn't created equal, and information in the private world is not created equal either. And so if you have those two things and can find the right companies or the right sectors, you not only can structure things in a unique way, you can create value through that sort of governance model that is very different than how you create value in the public world. So that was a lot. Thank you for bearing with me. Happy to answer or open it up for questions.
So Drew, Sophia, and Andrea have microphones, so if you've got questions in the audience, please get your microphone.
There's one over there.
So I'm in finance, and of course, the CPA firms have to do these different investment categories for pricing. You mentioned that the private market is marked or priced out every quarter. Can you talk about how that process actually happens? Because I have no idea.
Yeah, no, that's a good question. And so all of these fund structures are audited, and so the same way, you're audited with whatever public market manager, and so there are audited financials that happen at least one time a year. They look at how you're coming up with the number and the formulas, but they also look at, more importantly, the methodology. Are you doing and valuing the companies the same way today than you did 12 or 24 months ago? And so I'd say it's not only audited in the traditional sense of, are these real numbers? Can I trace it to the CFO and the compliance certificate that the private company signs? No different than the public side. It is SEC regulated, FINRA regulated industry, but it's also the process of how you come up with the values and the numbers. The other piece of that is, and this is to be fair, there is a lag. So we typically report 4 times a year, and our reports don't come out, generally speaking, for 45 to 90 days after the end of the quarter. And so there is a bit of time between when we put the values on these companies. But again, the auditors or CPAs, we use E&Y, we use KPMG for our own balance sheet as well as for many of our funds. They're auditing in the same way, and the companies are audited in the same way, even if they're private, than they would be if they were publicly listed companies. There's a different regulatory threshold, obviously, but it is very similar in terms of understanding the numbers and the process of coming up with the methodology.
Yeah, I was interested in that very last slide, in that the dispersion in the returns, it looks like. And it kind of reminded me of some of the issues that I've heard about, which is about the risk of choosing the right funds, right? Mm-hmm. And so is there a strategy that's required in private equity to buy a lot of funds, like you would, basket of stocks, number one. Number two, how much funds do you really need in order to play successfully in the private equity markets and not have too little capital to do it correctly?
Yeah, great questions. And I'll start with the last one because it's something we wrestle with a lot. And you saw the average risk of some level of loss is about 1 in 5 companies. And so to your point, it probably doesn't make sense to pick 1 or 2 companies every single year. And so I'd say the philosophy around portfolio construction is very similar to what you'd have in the public market context. There is a prudent level of diversification that is required in terms of how many funds, the underlying companies within each of those funds. And I'd say on average, most of our institutional clients, who are most of whom have been investing in this space for the last 20 or so years, and where a lot of that growth has come from historically, they'll invest in anywhere, the average client, 3 to 5 funds per year. Because if you think of a life of cycle of a 10-year fund, there's usually a 4 to 5 year period where you invest or go find the assets, those 50 to 60 companies. And then the second sort of 5 years is the harvesting of those transactions, selling them after 4 and 5 year hold periods. So that is a cycle where you need to continue to deploy because capital is coming back, even though it's still going in. And I think that's how most institutions have thought about their portfolios. I'd say the other big difference, and there's a lot of data on this, research on this, public sources, allocation, the percentage of your total portfolio, if you have public, you have private, and you have fixed income and other things, it continues to grow. So I'd say on average, our clients in the early to mid 2000s in this private market space were anywhere from 1 to 5% in the private landscape. Today, most of those exposure are in the sort of 5 to 10% space, I'd say is the sort of middle band. We have some clients on the insurance side or family offices or some smaller, more nimble investors where they're at 20 or 30%. And not to make it a total sidebar, we had a sort of prediction, and we create these outlandish predictions. We call it reasonably outlandish. Our prediction, one of them this year, was that in 15 years, most investors will have 50% of their portfolios in private investments. Again, if you think of the landscape, the numbers of companies, if you're not investing in it, you're just missing a huge part of the world if you're only in the public side.
Thanks. Excellent presentation and great data points. I'm just curious, with higher cost of capital interest rates right now, just your broad perspective on that. I imagine you'd expect lower returns on the private side as well as the public, but still outperformance. And then do you have an absolute number in mind, just like a midpoint for return expectations going forward? Yeah,
I think you're 100% right. And so we're nerds, we map this out. So if you think of like a bell curve distribution, if you look at, but for this last year, if you look at the last 5 years prior, they have been in the 80 to 90th percentile of distribution of returns for public, for privates, and so 50% just is the median. There's sort of the rule of averages where things must, so I do think there will be some capitulation, whether you're talking about private or public, it's gonna be correlated, and absolutely 100%, if your cost of borrowing, it's like when you buy a house, right? If your mortgage rate goes up 5% from 2 to 7, the size, the value of the home you can purchase because your cost of debt is higher becomes smaller. And so that's what has happened over the last year. You saw the fundamentals, the earnings of the companies, the margin, those all look pretty good. It has been a valuation correction because interest rates, debt costs have gone up, and it's the same with buying a company. And so you're going to see a correction in terms of the purchase prices and values that those investments are held at. You've already seen that happen and play out. The question is, and it does depend on where interest rates go, which is back to my comment, I think you'll see neutral interest rate policies over the next quarter. That'll mean, hopefully, valuations stabilize. You're not trying to catch a falling knife of where interest rates go, and therefore where do values fall to. But it absolutely, I think, means returns will come down. They have. But on the flip side of that, the same asset maybe last year you were buying for 14 or 15 or 16 times, in the new normal of pricing and interest rates, the new buyer's only going to afford to pay you 10, 11, or 12 times. So it can, over a 5 or next 10-year scenario, be very good, especially if when down the line you can sell that business you bought for 12 today for 15 again in 5 or 10 years. Any others? Tough. Well, there we go.
Thank you. With all of the positive trends that you've just shown, why is it that it's only 5 to 10% of a traditional portfolio, and if the movement to 50% in the long-term future is really an idea, why aren't we there now?
Yeah, it's a great question. The quick answer is it's expensive, it's an expensive asset class, and it's illiquid. So that has been what I think has held investors back, not having all the data or understanding some of the liquidity. The management fees are typically higher than what you could afford to buy in the public world. But all that performance you saw where there was a higher included the net of all those fees. And so part of the reason it remains expensive and hasn't seen the fee reduction like the public side is these managers, again, they'll tell you, oh, we're building these big teams, and they are, and they're creating all this value. But the other part is, well, the returns and the performance have continued to consistently be there. And I'm still building my teams to help create that value and go into these companies and help build them. And so it has been an expensive asset class. There's no denying that. And I think that has been just optically a challenge for a lot of investors, particularly if the asset class starts to move into 401k, individual retail investors. That can be, wait, I'm paying 30 basis points on my public, and I got to pay 1.5% on my private. So absolutely the fees. The other piece is the liquidity. Part of the value and why you create the value is back to, again, what I've already said. You hold these companies and sort of you can build not only and not make decisions based on the next year or the next month or the next quarter. When most managers buy these assets, they have a 5-year plan. They say, here's how we're going to create value, here's the landscape, here's the companies we may want to purchase or fold into our assets. So none of that is frankly dependent on what happens with interest rates in the next 6 or 12 months. It is a long-term philosophy. The flip side of that is you can't get your money back, right? And it has to come back to you when they sell and turn around those assets. And historically speaking, on the equity side and the private landscape, the average hold period's been about 5 years. So if you don't need the liquidity, I mean, that's a whole nother presentation we can always do next year of investors' views of their need for liquidity versus what they actually need. Because I tell you, I frame that as a negative, and most investors consider a negative. If you look at the global financial crisis, the structures of the asset class saved investors from themselves. When everyone sort of was panicking and pulling all of their cash out of everything else, which, by the way, was probably the worst time because your values had already come down, you can't do that in our world. You're committed to a 10-year limited partnership, and so therefore it sort of protects your value if you do believe in the long-term creation that these managers are providing.
Okay, last call.
Before I go, I'm also not, I just want to make one thing clear. There's value in having public liquid assets as well. We're not saying throw the baby out with the bathwater. This is it. Yeah, they're gonna pour drinks on me later. There is value to having both. They are both diversifiers. You can blend them in. people's returns, their risk targets are different. So are their liquidity needs, so are the needs for exposures, so is the need to build allocation. That's one of the benefits. In the public side, you can build allocation and buy something seamlessly. In our world, you just heard me say, a fund takes 4 or 5 years to build their portfolio. So just to be clear, and I'm sorry to the Wellington table, but we're not saying this should be the end-all, be-all. That's never a good decision for any investment.
Hello, Drew. 3 questions in one. What is your process for finding the companies? Do you find that they come to you or you go to them? And do you limit yourself to the U.S. market, or do you invest outside the U.S. as well?
No, great question. So the asset class is global, so it is a global phenomenon because the private company landscape is global. And the mix of how we find these opportunities, again, I think that's part of the value, because again, we can all pull out our phone, we can find any public company we want right now in the next 30 seconds. You have to go turn over rocks, stones, you have to sometimes go out and find things, and you have to know and understand industries and how to build and create value or what to acquire or not. The other one, though, that I think is fairly strong, if you're a company, a board, a trustee of a business, if you know that there is a manager who has a playbook and a track record in an industry or in a segment where they've done some great things over 4 to 5 years, and you're the manager of that business, it's not the worst thing if someone tells you, don't worry about things for 5 years. We want to go from point A to point B in 4 to 5 years. We don't have to sort of report publicly. There's going to be volatility. We're going to be fine. We'll manage through that. I think that's why you see companies staying private for longer and seeking out private capital solutions because of that sort of long-term orientation.
Drew, thank you.
Yeah, thank you.